Hey everyone, Aaron Philbeck here at Kai Association, and I am joined by Jeff Rubin, who is the Chief Investment Strategist of Total Portfolio Management at CPP Investment Board. Jeff, thanks so much for joining me.
I really appreciate it. Thanks for having me in.
Well, great. So Jeff, first of all, appreciate your contribution to both the first TPA piece that we put out a couple of years ago, and then this follow-up piece where we're kind of answering the call based on some of our roundtable discussions and tours around the world of trying to answer the question of this is great, but how do I actually implement this in practice? And before I ask you a couple of questions, I want to preface this by saying, one, CPP has been at this for a long time. And in terms of where you sit on that spectrum, I would say you're one of the fullest adopters of TPA, at least from our perspective. And then second is this conscious decision, like most Canadian pensions, to manage most of the assets internally using internal talent. So Jeff, for our conversation, I want to focus mostly on team structure. We talked a lot about governance and culture in this follow-up piece, but I think a byproduct of that is how your team is structured. And one of the comments that you made in our interview was this whole idea that TPA can be done with 4 people or 400 people. It just really depends on your setup. So I'd love for you to just talk about that a little bit and how you kind of see the philosophy being adopted and how that relates to size.
So again, thanks for having me in, and great that we earned the sequel on this one. I look forward to kind of talking about some of those elements of the total portfolio approach that, as you note, really do fit institutions of all different sizes and complexity. If they have a couple of ingredients in place, and you mentioned them, it's probably worth just quickly reemphasizing. I think there's really kind of 3 fundamental elements of the total portfolio approach that need to be in place. The first of which is the governance. And I know governance, it doesn't sound terribly sexy to talk about the structures within which we invest, but it's vitally important for the total portfolio approach that management, the investment team, has full accountability for the development and delivery of investment returns. There is no preset asset allocation. There's no preset portfolio, fundamental kind of underlying portfolio composition that is given to management. Management has, in a total portfolio approach, really has full discretion to design a portfolio that meets the risk expectations of governance, but is otherwise free to build out that portfolio in ways that they think is going to best deliver against the objective that is set by the governance. That's without that governance piece, the rest of it really isn't going to hang together. And I don't think that kind of clarity of governance is necessarily the province of larger or smaller funds. I think funds of all size can do it, but it's difficult. And there are reasons why the historical governance is used by most institutions. There is a clarity of accountability. We know exactly who is responsible for the setting of the asset allocation and who is responsible for beating the benchmarks that are effectively attached to those allocations. So the simplicity and clarity of the strategic asset allocation approach is well understood and used in our industry, but it can limit the performance of delivering against an objective that the total portfolio approach can deliver. So the first ingredient is governance. The second ingredient is a capability, a means of understanding the fundamental risk characteristics of all asset classes in the portfolio. And I know that sounds like a mouthful, and when you start talking about the risk characteristics, the mind kind of immediately goes to very complex solutions to understand the risk, but it doesn't need to. It can be even some thought put to which of our assets are really going to perform best in high growth environments, and which ones are going to perform when rates are moving out, or when inflation is coming in with under or over expectation. I think even a loose grouping and understanding of your assets by their performance in different environments, even that can provide the kind of insight that allows you to think not about the asset class labels, not about building a portfolio of asset class types, but of building a portfolio of investments or assets that have certain types of exposure or performance to different risk environments. That's what we're talking about here. And it can be done quite simply. I've seen institutions that simply group their equities, both public and private, into high growth, and they will group their infrastructure and their fixed income, and maybe some of their real estate into rate sensitive assets, and credit into assets that are more sensitive to the credit conditions within the market. So just some broad categories of asset performance can be enough to start sorting through and thinking about your portfolio, not in terms of its asset allocation, but in terms of the kind of the balance of exposures, the balance of performance that you will get from that portfolio. That can be done quite simply. It can be done with teams that are either doing their own work or using off-the-shelf risk models that will give you some of that insight in ways that again, doesn't necessarily have to be a large team, but it has to be a team that's really thoughtful around not the labels of asset classes, but the underlying exposure, underlying performance of those. The third ingredient is you need to have a means of, once you develop those views of how your portfolio is exposed or balanced in different conditions, you need to have a means of delivering on that, to ensuring that you can shift the portfolio from areas of overexposure to areas of underexposure. You need to have some fluid means of being able to invest in ways that is delivering the portfolio composition that you think best delivers against your objective. So does that mean you have to have some internally managed portfolio with which to balance perhaps the externally deployed? In some cases, maybe, but there are even possibilities to be entirely externally invested, where some of those external mandates have a horizon that allows you to more effectively respond to the composition of your portfolio, that you're not beholden to very specific kind of asset class buckets, that you have an ability, even with the use of external managers, to balance out the portfolio in ways that maintains the overall structure that we talked about in this second part, that allows you to do that through cycles and over time and as conditions change. So it's those three pieces that institutions really need to build out TPA, this really clear governance of delegated accountability to management, the ability to understand your portfolio not at an asset class label level, but at an underlying economic exposure level, and a means of maneuvering the portfolio or responding to that consideration in ways that allows you to adjust the portfolio over time and maintain it. We have one particular approach to doing that probably is more on the well-developed side, but I think there could be a range of institutional approaches to this problem that really take advantage of some of that total portfolio approach flavor that we believe will deliver superior performance over time.
So Jeff, I want to come back to a couple things that you mentioned, but maybe starting with that size component of your team, and maybe you can use this as an opportunity to talk through CPP's evolution of perhaps starting a little bit smaller, but then you've added people, you've gotten more sophisticated over the past couple of decades managing through this evolution. How do you or maybe historically, how have you, and then how do you think about the team composition and the structure of that team, and where you add personnel as you're trying to get much more granular? Because to your point, you are doing this maybe at a more scientific level in terms of the factor exposures and the economic exposure underlying it. So you need people and you need technology in order to facilitate that. So talk through that evolution of the team itself.
Yeah, I think the points that you just made there around the considerations for what team size might look like are right on in terms of that size, in terms of the evolution of the investment organization. Important to know, we have been around for, let's call it 25 years in our current form as an active investor. And even at the outset, there was already clarity that we were going to be a very large investment organization. We started with, relatively early, around $100 billion of assets to manage, with very clear line of sight on the basis of the nature of the Canada pension plan itself, a very clear line of sight to grow to 500 billion and ultimately $1 trillion and beyond. So I think that gave us the confidence to invest in teams, to manage the portfolio, and to deliver on this total portfolio approach to the fullest extent. So I think there has always been that institutional commitment. It's a choice. It's not our identity to be a total portfolio investor. We chose to be a total portfolio investor, and we did so because of a deep conviction that if done well, you can better deliver against an objective of maximizing returns at a particular level of risk that you want to take. So that commitment, I think, emboldened us to, start with a reasonably sized team and to continue to grow that team over time. It's been a team that has always been in the investment department. So it's always viewed as an investment department, the team that fundamentally manages the total portfolio approach. It's a team that, as you noted, is staffed with folks that have a quantitative background, but always in the service of making investment decisions. This is something that we've really focused on here as an organization, is that despite the staffing of quantitatively minded folks and the development of models and systems that allow us to deeply understand at a granular level the holdings that we have and the economic exposures they bring to the portfolio. We always want to ensure that work is being done in the service of making investment decisions, because the total portfolio approach takes very seriously things like the characterizations of your assets. And this is not just an academic debate. When you are thinking about whether or not private equity is levered, has the same kind of exposure as levered public equities, that leverage, whether it's 30% leverage or 15% or relatively unlevered, whether the exposure of that private equity asset class is more akin to large and mid-cap equities or small cap equities, these can feel like kind of interesting quantitative and analytical exercises, but the outcome of that has a profound impact on the actual portfolio that we manage. As we think about the level of risk in our commercial real estate portfolio, changes in that level of risk in the commercial real estate portfolio, a change in the consideration, what it is contributing to our total portfolio, can have knock-on impacts to how we manage the rest of the portfolio to deliver against that total aspiration that can amount into the tens of billions of dollars of notional investing in other parts of the fund. We are deeply invested in an analytical, a quantitative, systematic foundation for doing all of this work. But again, it's worth emphasizing we do that in the service of making very important investment decisions. And it's those, it's the use of that apparatus to make those decisions that we really focus on. Because of this commitment and the size of our portfolio, importantly, the breadth of our portfolio, the fact that we do invest around the world in virtually every scalable or sizable investment, kind of institutional grade asset class. Because of that, the apparatus that we've built to understand the fundamental risk characteristics of our portfolio, to be able to look at everything on an apples to apples basis, to be able to add all of that up into an overall portfolio view that allows us to understand whether we are at the target that we intend or whether we're off that target and need to trade in the parts of the portfolio to get us back onto balance. We've committed quite a bit to that, quite a bit in terms of people, in terms of data, in terms of systems, in terms of risk modeling, in terms of the techniques we use to really understand the risk exposure of those different assets. So, these are large teams, in the many dozens of folks who are doing this work. We take a look at some of the other large institutions and how they are implementing their total portfolio approach. And there are a few of the largest institutions around the world. GIC would be an example that I think are similarly constructed and have similar kinds of investments in their teams that are running the total portfolio approach. But that has been our orientation on this one is to invest in an investment team that is doing analytical work in the service of making profound investment decisions alongside their investor colleagues and other departments that are actively investing in their spaces, so that this total 700 billion plus portfolio is really being structured in ways that we think best deliver against that singular objective we have of maximizing returns at our risk target.
So, Jeff, talk a little bit more about the technology and the apparatus behind the insights into the portfolio. So, there's clearly an advantage to having the internal management because you're hands-on with those investments. But if you're trying to take that portfolio view and look across everything, that can be challenging if you don't have the right systems in place. So, how have what are some of the systems that you do use, things that you're looking for, and how has that changed as you've gone through this evolution?
Yeah, the systems have to have access to all of your holdings. It has to have access to those holdings in ways that, again, allows you to do the work on understanding what is the fundamental underlying economic composition. What's the underlying exposure profile of those holdings? Does it need to be done at the absolute kind of QSIP line item level, or can it be done at portfolio levels? I think there's opportunities to find the level at which you really want to be able to express it, but you do need to really understand your holdings well. That, obviously from a book of record standpoint, we have a very clear view of all of our holdings, but from an investment book of record standpoint, to really understand the nature of our holdings, even that's not a trivial exercise with the breadth of portfolio that we have. The real estate folks, historically, they would store their investment information on their portfolio in a real estate system. And the credit folks would have their own credit system, and private equity another system still. We've really had to make sure that we can develop a very clear view of the investment profile of our portfolio across all of these different asset classes. That's a challenge. The accounting book of record system that allows us to effectively understand values and exposures and kind of asset level composition is not always the best system for really understanding the investment nature and the investment profile and characteristics of the portfolio. So I think over time we've tried different approaches. Can we build off of the accounting book of record? Do we need to build bespoke investment book of record approaches? We all know, we've all struggled with, we've all had our moments with these kinds of big systems efforts. I think we've found ourselves in a place where we're confident that we have a very clear view of our holdings. And it's a view that allows us to then apply risk modeling to those holdings, which is that important step of understanding the actual nature of the underlying characteristics of our holdings. I think most institutions are comfortable with some of the third party risk modeling, and BARA, for example, is one that is used frequently within the industry, and I think does a great job of being able to project some of the fundamental nature of assets, or at least certain types of assets. When you get into private assets, it can be more tricky, and we see some interesting things happening in the kind of data provider space, where there are some mergers and some acquisitions happening, where I think service providers are looking to be able to provide risk-based views of portfolios of both public and private assets in more comprehensive ways. So I think there's some interesting developments there. But we've gone the road of building our own risk model here. It's a risk model that we're always going to corroborate with what's happening in the external third-party provided models. But we have our own model here of how it is that we can take a look at this pretty vast and varied investment portfolio that's around the world in all sorts of different asset classes, different characteristics, how we can project all of that into a single view of portfolio risk and return. That's work that we do internally. It's significant work, and it's work that we are committed to. Again, because given the scale of the portfolio and we think the size of the prize involved with getting this right, the amount of incremental returns that we can generate, that view, that internally developed view of the risk and return of the portfolio is something we've invested in. So that system helps us understand the portfolio. And then we have built a system to deliver on that third pillar that we talked about at the outset, which is how we then shift the portfolio and ensure it's responding to that view of the risk profile that we assess. So we have built again an internal system to flow that view of risk into a system that allows us to understand where we need to rebalance the portfolio in order to maintain the shape, the factor-based composition that we think is best for the overall portfolio. So I think that's a very quick sketch of the systems that we have in place. Again, broadly developed organically over time with lots of sweat and lots of labor and lots of making sure that we are staying on top of what works and what doesn't, and always getting better. It's a lift. And for those who are looking for a kind of pure off-the-shelf solution to all of those parts, I don't know if there's kind of one solution that can cover it, but I think there's opportunities to deliver on all three of those pillars that I talked about at the outset, including the characterization of the portfolio and the ability to act upon that in ways that keeps your portfolio where you think it is best suited.
So, Jeff, maybe a final question for you before we wrap up here. But one of the things that was interesting, I think, for us as we talked to all these different asset owners that were at different parts of the journey along that SAA to TPA continuum, was the experimentation that took place, particularly early on in that journey of, maybe there's some top-down conversations and then some bottom-up shifts with the teams that you're managing and some cross-departmental collaboration. As you kind of talk through TPA, maybe from your own perspective, but for those that are trying to think about this or are wrestling with this in their own organizations, what are some things that organizations can do to experiment a little bit to move them closer to that TPA lens?
Yeah, I think maybe the first thing to do is even start looking at and thinking about your holdings through a underlying factor-based or economic-based view. Just having those conversations, I think, is the first step on the way towards a total portfolio approach. Not acting on it immediately and not trying to design a portfolio around those things, but having a conversation with your investment teams who speak a language that's often tailored to the asset class within which they work, and have that conversation around is it true that all infrastructure is infrastructure, that there's no differentiation in exposure? Well, is it contracted cash flows? Is it market-based cash flows? What are some of the drivers there? Where are you in the capital stack? Are you kind of in a first loss position with higher risk or less loss? How are you thinking about the amount of leverage on that and its implications for the underlying risk profile? I think providing some of these factor-based views to your existing portfolio and some of the asset class holdings, I think that can be a really effective first start. And typically when you do that, the asset class owners are the first ones to say, well, of course, not all real estate is the same. If it's a 20-year leased, the credit tenant property is going to have a very different characteristic than if it's a data center that we're building. Why would we think that just fills a real estate bucket in some kind of undifferentiated way? Of course, we want to think about the composition there and understanding those are two different risk and return propositions, both of which might have a role in the portfolio, but are clearly doing different things. So I think getting that information, just being able to look at the portfolio through a factor lens, through a lens of underlying characteristics, that is a great start for folks to start to get it. All right, I understand that there is a difference in the exposure. And that then might lead to a next step, which is what might we do about it? If we can develop that view, do we want to think about managing the amount of risk that we have in the portfolio? Do we want to start thinking about it? Is there a target? Is there an aspiration for the kind of overall composition we want? I think that's one way to leg into it. It's a way to to leg into it as well with the governance that we talked about. I think one terrific way to start building upon an essay is to say, here's the asset class view of our portfolio. We have a certain amount in public equities and private equities and hedge funds and such. And here's a different view. Here's a view where we're kind of looking through that and trying to understand here's how it's evolved over time. And we seem to be getting more or less risky, even though the basic portfolio compositions remain the same in terms of those asset class labels. Feels like a great start to have those conversations and to experiment around that first understanding of the portfolio before you marshal your resources to respond to that in ways where you were designing explicitly for those exposures, and then making sure your portfolio is being adjusted to deliver on that design. Those are perhaps the later stages of the total portfolio approach.
Well, great. Well, Jeff, really appreciate your participation, both in the first one and, of course, the second one as well. So your insights are incredibly helpful, and I'm looking forward to having the world read this. So thanks for your time, and looking forward to catching up sometime soon.
Great to see you. Thanks.